So I'm just going to run through some of the observations we're seeing within our fund, some of the issues that are being confronted by it, and then William's going to come in and give you the solution on what to do with all these issues. So back when Australian Super was formed, 2006, we had about 88% of our members in the default option, the balanced option in the fund. At the end of last year, that was down to about 73%. And you can see from that graph that it's just a fairly constant decline as members start to pick up on investment choice and switching. So the right-hand side of the slide sort of shows where the members have been going. And you'll see there that around 2008-9, during the global financial crisis, the money really started to move towards some of those defensive options of cash, fixed interest and capital guaranteed. And I guess one of the observations we've had is the old days of there was always cash coming in, there was plenty of cash in the balanced option, it was more a question of what do we do with it, has started to change over the last few years, and there's a number of other issues which need to be considered and thought about. So one of the other things that is we're spending more time now on is the demographic of the underlying membership in the accumulation options. So this chart is just breaking them up into 10-year age bands, and you'll see that in that 41 to 50 age group, and the more important 51 to 60, and it's sort of a bit of a shock when you move from one demographic into the next demographic on these charts, but I recently went through that experience. And you'll see that those two age groups alone are about 50% of the total funds under management. So as the membership is ageing and the balances in some of those areas is increasing, it's starting to put more focus on, well, how's this changing over the next 4 to 5 years, 5 to 10 years, and what's the impact that's going to have on the amount of unlisteds we can hold in the portfolio, how we should be managing other parts of the portfolio, and how do we position ourselves so we don't get caught in a situation that limits our ability to have the asset allocation of the different investment options where we actually want it. So Australian Super opened up a pension option in 2008, and this is just showing how that pension option has grown over the last 6 years. So you'll see there in 2013, end of the financial year, it was about $5 billion. That now represents about 7% of our funds under management. So the members are coming out of accumulation and into pension, as well as we're seeing people coming into the fund first time to access the pension options. And the interesting thing about the pension options is where they're actually investing. So left-hand side is the accumulation options, right-hand side is the pension. 3/4 or just under 3/4 of the accumulation in the balance plan. Pension options, much different. About 1/4 in the balanced option, and the conservative balanced and the stable option have a much higher attraction for the members, as do a number of the fixed interest, cash, capital guaranteed options. And when you drill down into the different pensions and accumulations, one of the interesting observations is that the pension conservative balanced and the pension stable for us are receiving greater cash flows than their accumulation options. So we're starting to see some shifts in where the members are investing as they go into pension, and the different asset allocations that those options are having, and then how that plays back into the broader way we construct those investment options and manage the allocation of investments across the different options. Maria talked about the Caravan Effect. What we watch is the movement in the ASX 300. What this chart is basically trying to show is that as the ASX moves up or down, we see a pretty good correlation of what the members do. And I think when we looked at this in some detail, it was about a 6-week lag that we're experiencing. So if the market dropped significantly, about 6 weeks later, we'd see the members switching out and going into the conservative options. As the market rises, we see them switching away from the conservative options back into the growth options. So the whole issue around how we label what the options are and how we set the objectives for those options becomes very important. And the whole way we manage the member experience and what they see and the information they get around what we're doing. And we've done some other analysis of the people who switched out of the balanced option at the bottom of the GFC, where they would be now if they'd stayed in the balanced option versus where they are. And it throws up some very sobering information about just how much value destruction can be done to the individual members with some of this switching. But it's another part of the whole equation of things that you need to be monitoring or thinking about in managing the cash flow as it comes in to the fund and where you're placing it over time. This chart just breaks out the switching over the last 3 years between some of the different options. So the blue is what was happening in the 2011 financial year. Not a lot of stuff really going on there. Financial year 11-12, so that was where I think our balanced option did about 1%. A lot of people moving out of balanced, just under 1.5 billion. And you can see the high red bars around the cash and conservative options. 2013 financial year, which just finished, you see them coming out, which is the green bar. You see them coming out of cash fixed interest again and going back into some of the more growthy options. And our experience for the couple of months in this financial year so far is that our best performing option, which was the sustainable international share option, is getting a lot of people switching into it. So the year that the diversified fixed interest option was our best performing option in 2011 and 12, that got massive switches into it. So once again, it's another indicator of what members are doing. And the other key correlation we've noticed is when they get their annual statements and they see what the various options have done, our switching spikes again around that time. So all these things, we've been monitoring, starting to bring together to better understand what's going on the liability side across the different investment options. And then on top of that, we've had APRA come out with their prudential regulations to help us a little bit more around stress testing and how we're reporting liquidity, etc. So we've been further refining the stress testing that we've been running for the last couple of years and looking at the impacts of what happens with markets, currency settlements outstanding on the hedging program, the various elements when members switch, the general inflows and outflows that we get across the fund, what our commitments are on some of our unlisted assets that are sitting there, and building that into comprehensive models that we can stress and shock with different scenarios. And this allows us to look at, well, how much can we have in any liquid assets in the portfolio, and what type of liquid assets can we do? What's the time frame that it takes us to realise different parts of the portfolio? So there's generally been a big focus on the unlisted assets, but you start looking at some of the exposures you hold in small caps, some emerging markets, etc. And you run the analysis of how long it takes you to move out of those investments, and you start to see that, you know, some of those investments can take weeks or a month to get out of in an orderly manner. So building that analysis into the overall liquidity analysis has been quite important to us, as well as what the underlying managers of pooled funds do in stress situations. Do they close off redemptions? Are they able to get cash back to you? Is another element that we've spent a lot of time looking at and talking to the various managers about. So that's basically just to set the scene and some of the issues, and you can see it's quite a broad range of issues which need to be thought about and considered. And now William's going to come along with the solution of how to do it all.
Thank you, Peter. I think Peter's pretty generous in saying that we have the solutions to the problems, but what we do feel we have are tools which will help super funds get a better handle on the liability structures that they're facing, and obviously they're specific to each particular fund. So just a bit of background, obviously all investment portfolios support some sort of liability structure, whether or not it's a DC fund, accumulation, DB or an endowment. A lot of work has been done on the asset side, but not much work has been done on the liability side, especially for accumulation funds. And I think the financial crisis which occurred was a bit of a wake-up call for a lot of super funds who were in the line of thinking was that we have solid cash flows all the time. We don't really have to think about these issues to any great extent. So the regulatory environment. So obviously with Stronger Super, My Super and the prudential standards, that's casting a greater focus on regulation on super funds, and specifically the Prudential Standard 530 stipulates that each fund needs to have a liquidity management plan in place, and that plan can consider, amongst other things, for, the ability to forecast contributions, the ability to forecast benefit payments, and also member switching. And they're sort of the key things that I will talk about in my presentation. In response to some of the challenges being faced by super funds, we've developed two specific quantitative tools which will allow super fund executives and the board to get a better handle on how the liability structure is changing given cash flow changes and also member switching. The first tool is a fund cash flow forecasting model, which effectively allows you to flex certain assumptions and inputs into the net cash flow position to get a sense of the impact on the net cash flow of a fund. And the second tool is looking at predicting member switching behaviour. We've actually used both of these tools in practice to assist one of our funds, Australian Super, to get a better handle on their liability structure. So as I said before, the cash flow model is effectively looking at changes in demographics over 10, 20, 30 year time horizon, and looking at what changes or what changes in particular factors can have on the fund cash flows at an option level or at a fund level. Obviously, it's not rocket science in terms of what the key inputs are, like you've got cash inflows and also cash outflows. But what we've found in some of the initial analysis we've done is that for cash inflows, it's most sensitive to the salary growth rate of the membership base. And for cash outflows, it's most sensitive to the growth in the average account balance of members. So what can we learn from the experience we've had over the last 5, 10 years, and what can that teach us in terms of looking forward? So I think there's 3 key takeouts that we would have, and that is, over the last 5 to 10 years, cash flows, although funds are getting bigger, there has been a net decline in cash flows, net cash flows for funds. The membership base is maturing. The demographic, the average age of the membership profile is getting older. And as a result, because they've had more time in the superannuation industry, their account size balance is getting larger. So the super fund industry in 10 years' time, what do we see? Well, our projections indicate that over the next 10 years, the net cash flows for super funds on average will halve in size to what it currently is as a percentage of the current size of the fund. And the implications of this indicates that asset allocation will be more difficult to implement. Liquidity will be a bit more of a constraining factor than it has been over the last 5 to 10 years. And the pension option will start to grow and become a more significant part of superannuation funds. So we can show this graphically on the next two charts, whereby on the left-hand side we're showing effectively net cash flows effectively halving over the next 10 years. And on the right-hand side of the chart, you see that the contribution, the importance of contributions to net cash flows becomes a shrinking component, and that's the dark grey bar there. It's slowly trending down.
So William, that's excluding investment return?
No, that's including.
That's including an assumption about investment return.
So what does this mean in 20 years' time? In 20 years' time, we feel that most super funds will be in a net neutral position in terms of cash flow, so no new cash flows coming in. The implication for that is obviously assets, whether or not they be in the unlisted space or the listed space, ones which can generate free cash flow, spitting out cash flow, whether or not that be an infrastructure asset, property asset, or an income fund, they'll become increasingly important to super funds in terms of their asset allocation. Product design, especially for pension assets, pension side of the fund, will become increasingly important, as being able to retain members will be a key drive in terms of how fast your net cash flow position will continue to erode. So graphically as well, what we're seeing here in 20 years' time is the number of members over 55 years of age, which is on the left-hand side, the yellow and orange components of the bar will start to increasingly ramp up. And then on the right-hand side, you can see the net cash flow position effectively being neutral level, and contributions will start to decline even more. In 30 years' time, what are we looking at? Well, the ability for funds to retain members in 30 years' time, we believe, will be the key drive of how fast they become cash flow negative. So what that means is investment returns will be the largest driver of your asset growth in terms of the size of the fund, obviously excluding mergers and roll-ins, significant roll-ins, but investment returns will be the largest driver of how fast your fund will grow. And obviously pension member switching, that will be an increasingly bigger consideration, and obviously the ability to actually communicate and tap into that pension market and retain those members will be key. So effectively, the chart on the left-hand side shows that in 30 years' time, fund growth decline will be driven by how strongly the fund can actually return, the investment returns of the fund will be. And obviously, on the right-hand side, the red line is actually below the horizontal line now, effectively meaning you're cash flow negative. So what are the key takeouts from the analysis specifically related to the cash flow model? Well, there are three key takeouts from our perspective, and that is the asset allocation will become more difficult to manage, and the ability to make dynamic asset allocation decisions will be much more constrained in the future. The asset mix, which is specifically relating to what assets are providing free cash flow generation, will be much more important than it is today. And product design, and I know you've already had a session on retirement, but product design will be very important in terms of being able to engage members when they move from the accumulation side to the pension side, and the ability to actually retain them will dictate how fast your decline levels will be as a proportion of a fund. So the next part of the work that we've done is looking specifically at member switching. The financial crisis was a wake-up call, as I said before, and what ensued during that period was member switching reached quite elevated levels. Although it's dampened down a bit, switching is here to stay effectively. And in a world where net cash flows are becoming increasingly smaller, the ability to understand switching behaviour and what drives that will be important in terms of managing the liquidity of each super fund. So on this slide, we've got a few charts which sort of are outputs from our model. Effectively, the model is quite flexible in terms of allowing you to being able to identify where the switching is taking place by state or whatever factor you want to cut it by, and also how many unique switches. That is members who switch. There will be members which will switch quite a number of times, but unique switches identifies how many individual members switch. And you can see that on the right-hand side, the grey shading indicates that members who have switched in the past are more likely to continue switching as time goes on. And for members who haven't switched that much or have only switched once in the last 12 months, they're less likely to switch, but they all aggregate up to meaning that super funds are experiencing a lot more switching from their default option or even their MIC options to other options.
So William, just while you've got that chart there, what's the data that sits beneath that? Have you taken an aggregation of client portfolios or different funds?
So this output's based on Australian super data. So as you can imagine, it's a pretty large data set, and it's effectively aggregating all their membership data across Australia.
I was looking at the Tasmania bar, thinking it's a very small bar.
Okay. Yeah. So what we found in terms of our member switching model is that there are some structural drivers of member switching, and the key drivers we've been able to identify is if you've got a large account balance, so that's the red line effectively, then if you've got a large account balance, you're more likely to switch, and that probably speaks to the fact that you've got a larger pool of money in super, you're a bit more engaged, and the older that you are as a member, the more likely you are to switch, and that's indicated by the chart on the right-hand side. Another factor which sort of determines how likely you are to switch is based on the fact that if you've actively decided to elect an MIC option, then those types of members are more likely to switch than members who've just gone into the default because they haven't made a selection. Gender also plays a pretty key role in terms of switching, and we see it from the chart on the left that males are more likely to switch than females. I'm not sure if that speaks to the fact that maybe males are a bit more overconfident in terms of their ability to time the market or pick times to move in and out of options. And also, the higher your wage, the more likely you are to actually engage in a lot more switching. That said, there are also cyclical factors which drive the switching from what we've seen. And obviously, as Peter alluded to, the returns of other MIC options are important as well. So what we see is there's persistence when other MIC option returns come out, and it's better than probably the one you're currently in. That usually results into some elevated level of member switching. And on the right-hand side, we've got market downturn. So whenever equity markets take a bit of a shock, like during the financial crisis, that leads to much more elevated levels of member switching. So the two charts here effectively show the black line shows what the actual experience of member cash outflows are, and the red line is what the model has predicted would happen with the data we've actually been able to test. So you can see here that the model, although it's not perfect, no models are, there is some predictive power in terms of how you can actually get a sense of what level of member switching there will be. And likewise for the inflows, the black line again shows the actual experience, and the red line shows what the model would have predicted. And this is based on looking at 3 months data in advance. So the model says that it is able to predict to some degree of certainty out 3 months' time what the member switching activity will be. So what are the key takeouts from the member switching work that we've done? Well, there's probably 3. One is that member switching is here to stay, whether or not you like it or not, it's here to stay, and it will be continuing. The fund composition does make a big difference in terms of the average age of your membership base, the salary profile, the number of MIC options you have, and also the performance of those MIC options. And also that switching partly can be predicted, at least over a 3-month window in advance. So that information is quite useful, especially if you're trying to manage asset allocations or liquidity of your fund. So just to conclude, liquidity in the next 10, 20, 30 years will become increasingly precious, and funds which have assets which provide a lot more free cash flow generation will be quite sought after and quite valuable. And I guess the final comment on this slide that I would like to make is that pension design or product design will become increasingly key, especially if you want to retain members who transition from accumulation to pension mode.